Welcome to the Gold Newsletter Podcast, your bank of knowledge of investment, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives.
This is the Gold Newsletter Podcast. Fergus Hodgson, your host. So pleased to be with you. And we're joined today, I have Brian London, my co-host in New Orleans, Louisiana, and one of my economics gurus, or someone I really admire and follow his work closely, Steve Hanke. He is a professor of applied economics at Johns Hopkins University, and he's also a senior fellow and director of the Troubled Currencies Project at the Cato Institute. He has a long history in the field, and he recently released his Notes and High Points in Studies in Applied Economics. So, Steve, there's so much to digest. Thanks for joining us today.
Great to be with you, Fergus and Brian.
Yeah, and we were just chatting before about how this is such a historic time for currencies, and that's why you're really focusing on an important topic. And of late, two of the countries which you have focused on most or a lot have been Argentina and Venezuela. And Argentina just this month had a major slide in its stocks by about 50% in a day. What are your latest insights in terms of the future of the Argentine peso? Will it be no more in a few years? Are they going to go to, I know you favor currency boards. What is the outlook for the Argentine economy, particularly with interest in their currency?
Well, the outlook is this from the long-term perspective, the same as it's been for 150 years or so, and that is the peso is a piece of rubbish. And periodically, every 6 to 10 years, they get in a huge currency crisis and a collapse of the peso,
right?
And political chaos and all everything that follows from the collapse of a currency. So at present, the currency has collapsed. Of course, they're under the direction of the International Monetary Fund. The Argentine peso collapsed once about a year ago, and they called in the firemen from the International Monetary Fund to supposedly fix the situation. Well, they didn't fix the situation, which is typical. They never do. This is the 22nd IMF program that Argentina has been on. I mean, they're just the recidivism is fantastic. They're just a serial problem. Anyway, they didn't fix it, and I measure the inflation rate using, by the way, purchasing power parity, and if you use purchasing power parity and apply it to changes in the exchange rate, you can calculate an implied inflation rate for any country, and this is the most accurate way to do it when you have very high inflation. So today, the annual inflation rate in Argentina is 85.63% on the 29th of August, 2019. So at any rate, the only way, Fergus and Brian, to get out of this thing is to formally do what Argentines always do. Whenever they get a whiff of trouble, they spontaneously dollarize the economy. They dump the peso and get into the dollar, and of course, by definition, the peso collapses then. So Argentines are smart. They know how to deal with this to some extent and protect themselves. They dollarize spontaneously. They officially have to get rid of the peso and dollarize the country. I think that's the only way that they're going to be able to solve the problem. And by the way, I'm concluded that all of Latin America, I've held this view for many years, that they would be so much better off if they all got rid of their local junk currencies and adopted the U.S. dollar, just formally dollarized all of these countries. I just read an article about Colombia and the Colombian peso that got a lot of attention, and the Colombian pesos had problems, not anything like Argentina, but about 50% of the value of the peso has been lost in the last 5 years. So what do people do? You get a bank account in Miami, or you get the greenback if you can in Colombia, and that's how you protect yourself. So there's an interest in dollarization there. You know, we officially, I was the advisor to the government in 2000 when they started dollarizing, and they finished that dollarization process in 2001. You've got Panama, Ecuador, and El Salvador. They're all dollarized already, and they do much more stable and do better than most of the other countries in Latin America, with the exception of Chile. Chile has a great advantage. They had the Chicago Boys under Pinochet, and they fundamentally changed the system, and it's, by Latin standards, it's really the most free market and the most liberal economy in Latin America. So it's kind of an outlier. It really doesn't behave like the rest of these Latin countries.
It is true that dollarization, particularly in the case of Ecuador, I'm less familiar with El Salvador, but it has been a check on the government in its capacity to basically print money or monetize its debt. Now, but how likely is it? Do you think this is the final, they've met the threshold level that Argentines will finally get behind true dollarization?
Well, I'm somewhat skeptical because the elites in Argentina always have had somehow, and why, I don't really understand it exactly. It perhaps is just a national pride thing on steroids, but there are a lot of well-trained economists, smart people in Argentina, and the elites that run the show, they resist dollarization, and they resist an orthodox currency board. They had something that was somewhat like a currency board with convertibility that they put in 1991, April of 1991. That lasted 10 years. It was great until it finally collapsed because they kept even breaking their own internal rules, and they had a lot of discretion in that system. It was operating really like a central bank with discretion, and ultimately they got tangled up, and the thing collapsed in 2001. So it lasted 10 years. They had a great run, and then it collapsed. The elites don't like this, and the political class doesn't like it. They like to spend money and run a fiscally irresponsible system, and the only way that system kind of gets taped together and holds together, they have to have a central bank to borrow money. And so you had Macri, who's the current president. He's supposedly a conservative. He really isn't. He's an Argentine. He's not really conservative. But what did they do? He was running big fiscal deficits, and he went to the central bank. And at that time, the governor of the central bank, very, very distinguished, well-trained economist, PhD from MIT, etc., was just printing money like mad, and that was the cause of the first peso collapse about a year ago. So you can't say that they had some numbskull running the central bank who didn't know anything. You had a very distinguished economist with all the credentials in the world, first-class credentials. And he was running the thing like any Argentine would run it. I mean, he was just running the printing press. The government would say, we need money, and he'd say, fine.
So, Steve, are you really, with these currency boards, are they only like temporary salves against the inevitability of human nature to overspend, and that they serve as a restraint on government for as long as they're around, but eventually the government does away with them because they can't stand that restraint, and then the whole process starts over again?
Well, there's some of that in the system, but there's never been a currency board that's failed, and I right now, all of the new currency boards I've been involved in designing and putting in. One, for example, in Bulgaria, put that in 1997, July of 1997, smashed a hyperinflation that was running at 242% a month, and smashed it within hours. And they still have it. They haven't entered the euro. The Bulgarian lev, the currency, with the currency board backing at 100% with euro reserves and trading at a fixed exchange rate, the lev to the euro. The lev is a clone of the euro, and it constrains if you look at the fiscal operation in Bulgaria, they run a very tight ship no matter what color the government is, whether it's left, right, center. They run very small fiscal deficits, and their debt to GDP ratio is one of the smallest ones in Europe. And that the public supports that. The public, any politician that tried to get rid of that kind of system in Bulgaria would be toast. It's a little bit like dollarization in Ecuador. Ecuador, they had a very leftist president. Correa was the president until a couple of years ago. Of course, he didn't like dollarization, but he couldn't do anything about the straitjacket that it put him in because the public opinion, about 85% of the public supports it. So it would have been political suicide if he would have gotten rid of the dollarization system and put the sucre back in with the central bank. It's a problem convincing the governments to put in dollarized systems or currency boards. And the currency boards are really the same in a way because they retain a local currency, but that local currency with the currency board setup is really just a clone of whatever the anchor currency happens to be. I mean, it could be gold for all that matters. I've recommended for Turkey, Russia, and Iran gold, because gold is a great anchor. It retains its long-term purchasing power, and it has an advantage over the dollar or any other fiat currency in the sense that it's not issued by a sovereign. So for places like Turkey, Iran, and Russia, if they had an anchor, they don't want an anchor that has any political taint to it. They would want something like gold that is not issued by a sovereign and controlled by a sovereign.
And of course, that's probably somewhat behind the logic or the rationale that Russia has had in so aggressively buying gold in recent years.
Oh, there's no question about it. That's exactly what's happening. Been a big buyer of gold. China's been a big buyer of gold. Turkey's been a big buyer of gold. And that substitution of gold for a reserve currency at the central banks in those countries has been one factor behind what is clearly, I think, the initial start of a bull market in gold. Stuck between $1,200 and $1,400 an ounce.
Yeah.
Actually, the top, the big resistance was 1365, and once it broke through that a few months ago, that was really the signal that we were in a bull market. And if you look what's behind it, it's a lot of this currency substitution going on, gold replacing the dollar. Now, why is that? That's because the United States, stupidly, they've gotten on this financial sanction kick, and they put financial sanctions on everything that moves almost, and that hinders and makes the use of the dollar and the dollar payment system, the SWIFT system, much less attractive. So people want to mitigate the risk of being tangled up somehow in U.S. based financial sanctions that are all dollar-based, by the way. It could even be the euro. So that's a big part of the gold story and the gold bull market right now.
The Gold Newsletter podcast is proudly sponsored by the Discovery Group of Exploration and Development Companies. To learn more about our exceptional track record and exciting future, visit discoverygroup.ca.
This is Brian with our weekly now updates on Discovery Group companies. Discovery Group is our proud sponsor of the Gold Newsletter podcast now. First up in our weekly CEO interviews is Chris Taylor, CEO of Great Bear Resources, which is one of the big successes in the Discovery Group. Chris, I would have to say that Great Bear is probably one of, if not the most exciting discovery stories over the last few years, at least, in the junior mining industry. Can you kind of give us a brief summary of what you found?
Thanks, Brian, and thanks for the introduction. Yeah, we've been very successful with Great Bear over the last couple of years with a series of high-grade gold discoveries that are present in the Red Lake District of Ontario. And what makes these really exciting is that the gold goes effectively within meters of the surface, and it's located right beside a major highway. So the project has great infrastructure access, and it's only about a 15 to 20 minute drive from a number of other producing gold mines in the area. So very exciting and very cost-effective exploration, and I think that's a formula that's been bringing a lot of value in for our shareholders.
Now, the Red Lake District is legendary for the richness of its gold grades and really the amount of gold that's been discovered in this district. And what you're finding then now are similar grades over similar widths and in similar geology to that district?
Yeah, that's correct. What we found is our original discoveries from a year or so ago, called the Dixie Limb and the Hinge Zones, are very similar to the high-grade gold mine, the main Red Lake gold mine that's operated by Newmont Gold Corp. And what makes that really exciting is that that was one of the most profitable gold mines in the world for the better part of a decade, and converted Gold Corp based on cash flow from the high-grade discovery from something that looked like a company of about Great Bear size to something that was really one of the, a multi-billion-dollar leading, gold producer. So it's very exciting to have found that. But even more recently, we found this new type of mineralization on the project along this big LP fault target, which is nearly 20 kilometers long. And that target is hosting disseminated gold and high-grade gold that, again, goes basically right to surface below a narrow gravel cover. And that's totally new for the Red Lake District. This is a totally new type of mineralization, and very exciting to have both of these types of gold, high-grade gold, located within a couple kilometers of each other just off the side of the highway. It's something that the Red Lake District hasn't seen before.
And, Great Bear has been a recommendation in Gold Newsletter, our publication, from the very beginning. And the share price has come a long way. It's been a huge winner for everyone, myself involved as a shareholder and all of our readers in Gold Newsletter. So the question now for investors is, well, after this big run, why do I want to invest in Great Bear at this point? And my point to investors at this stage that are thinking about investing in the stock is that with this new discovery and these new zones, the sheer scope of the potential that Great Bear offers is not merely that of a new discovery in the Red Lake District, but perhaps a parallel to the entire district that it controls. With that kind of upside, you really need to own this stock for the long term.
Well, we certainly feel that way in management. We've accumulated positions both in the open marketplace and within all the private placements that we've done over the last few years. And that means that we've effectively built up our shareholdings alongside all of our shareholders. And we're very much aligned with wanting to see, the same type of benefits that they have. So what we're looking at is here with these new discoveries is if I took a map of the project and I tried to put my finger on the center of mineralization today, I wouldn't be able to tell you where that lies. So that's really exciting for us as exploration geologists because the scope of the discoveries that we've made, it's really just getting going. And I think generally in this market or in this industry, generally you want to be able to follow the companies that show a track record of success. And that's certainly what our Dixie property has been yielding. It has been a sequence of high-grade gold discoveries, and we don't know when that process of discovery will end. It looks like it's wide open for further expansion.
So lots of news to come, lots of potential to be realized, 3 drills turning. So we're really watching this news flow very closely. Thank you, Chris, for bringing us up to date on Great Bear Resources, one of the biggest discovery stories out there in the market today. Thanks a lot. That's certainly been our contention here at Gold Newsletter and, of course, New Orleans Investment Conference, that we have entered finally a gold bull market. And there are a lot of factors behind it. I think that political factor or geopolitical factor that you're mentioning is certainly one when you see Russia and China so aggressively adding to their gold reserves. But also, I think it's a reflection of what's going on in the U.S. These South American countries and other countries that you feel should dollarize their economies, that's certainly a better move than keeping their local currencies and subjecting those currencies to mismanagement by the governments, which they do time and time again. But the dollar itself is a lousy house on an even lousier block. It's really in pretty bad shape itself. And one of the things we've been pointing to is the federal debt situation, that at this point, the debt is so large we can't afford higher interest rates or anything even approaching normalized interest rates, but just anything higher than the levels we roughly have today. We can't afford the interest payments on the federal debt if rates rise much at all. So we're stuck in this ultra low, easy and ever easier money environment. And that's, I think, one of the biggest drivers of this, what looks to be a long-term bull market.
Well, that's not exact. I agree with that diagnosis. Number one, the dollar is very strong. The interesting thing about the gold bull market, and what contradicts what you're saying, is that the dollar is very strong. And when the most important price in the world, there are actually two prices that are very important in the world. One's a dollar. In fiat currency space, it's a dollar-euro exchange rate, and the dollar is extremely strong against the euro right now, and essentially every currency in the world except the Swissy. The Swiss franc is in another league by itself. It's more like gold. It's extremely strong, and since World War I, it's the only currency that actually is appreciated in real terms on average on an annual basis is the Swiss franc. It's appreciated about 1% per year in inflation-adjusted terms ever since World War I. So it is the strongest currency in the world. Fiat currencies, that is, hands down. There's no question about it. But it's a small currency. Now, the dollar is the big one, and the dollar happens to be extremely strong relative to all fiat currencies, as I say, with the little exception of the Swissy. And if you look at the euro right now, the comfort zone I would have for kind of a stable zone for the dollar-euro rate, fair value, would be about 120 to 140, something like that. And right now, the dollar-euro is trading at about 110, 111, 112, something. It's been close to that. So it's out of that comfort zone. It's very much on the strong side. So the dollar is king. It's very strong. And the interesting thing is we have a bull market in gold. Now that usually does not accompany a strong dollar. It's usually you get a bull market in gold when the dollar is weak. Or you get strength in gold. I'm not saying a bull market, but you get strength in gold and strength in commodities. And when the dollar happens to be weak. Now, the dollar is very strong. Now, all the commodities, the industrial commodities, and everything but gold and silver and palladium, platinum, some other more precious metals are very strong now. Now, that's unusual. That's an atypical relationship. There's something else behind gold than the dollar, because if you were just looking at the dollar is strong, which would normally mean gold would be not so strong. It would be on the weakish side, as all commodities are. Almost all commodities are very weak now, very, very, very weak.
Except the monetary metals. And I think that's the point I'm trying to make, is that the dollar may be strong on a relative basis amongst fiat currencies, but if you include gold as a currency, then it's actually weak against gold because the gold price is rising in dollars. And I think the reason behind that is because, well, there are a lot of reasons, but the fact of the matter is...
The big one is the financial sanctions and the Trump fooling around with trade interventions and anti-free market activity and uncertainty, because there's a lot of regime uncertainty in the air. People don't exactly know what in the world's happening. By the way, at very low interest rates, the opportunity cost of being in gold is tiny now. So that's another factor that motivates this thing. If interest rates were high, the cost of being in gold, fundamentally a non-interest-bearing asset, not completely, because there's a gold loan market, and if you're sophisticated, you can deal with that and make a little bit of money. But generally, it's not something that yields a dividend or an interest payment. per se, unless you get into various mechanisms of structured finance, which can allow you to eke out a little interest on gold loans. So I would argue that all the uncertainty, regime change, the idea that we're in a trade war and a currency war kind of thing with Japan, not with Japan. That was the 1980s. The 1980s we were. Now the enemy number one is China, and we've got a lot of uncertainty associated once again with the Middle East as the Saudis and Israel try to drag the United States into a war with Iran. So there's a lot of uncertainty. So you have a demand for safe assets. What are the safe assets? The U.S. Treasuries are the only big, huge pool of safe assets, but of course they don't yield very much. But at least you're in what's considered a safe asset. And gold, which is big. And the Swissy, which isn't so big. Now, the Swissy, you want to go into Swissy, you're into mega negative interest rates.
Right.
So there's a big carry on. There aren't negative interest rates in gold. Gold's more attractive than the Swissy because the Swissy, you actually have negative interest rates. If you want to be in the Swissy, you have to pay.
Yeah, and it's not only that. I'm not big on financial over-regulating the financial markets. But I think what the Swiss National Bank is doing by printing francs out of thin air and then using them to buy up U.S. companies is just, should, if anything, be illegal. I mean, that's absolutely ridiculous. They're trying to weaken their currency by manufacturing new currency, but then they're using that new currency to buy U.S. companies. Great deal if you can get it. They can do it, and they are doing it.
So back to the U.S., by the way, the U.S. is not in a loose money situation. It's a very moderate, the broad money supply, the Divisia M4, which is accurately measured by the Center for Financial Stability in New York, it's only running about 5%. It's been increasing a little bit. Now it's up to 5% per annum, the growth rate. That is not a loose money. That's more or less in the sweet spot. 5.5. They're kind of right in the zone. So the idea that they're running loose money in the United States is just not correct. They've been running, in fact, very tight money. Monetary policy has been very tight ever since the Great Recession started in 2009. They've been overly tight in the United States at the central bank and with the regulations affecting the commercial banking system. 90% of broad money in the United States is produced by commercial banks. It's not the Fed. It's commercial bank. So the question is, why has money been so tight? Well, you've had the Dodd-Frank regulations. You've had Basel III capital requirements, increasing the capital asset ratios of banks. All these things have held the commercial banking sector, the big producer of money, they've dampened it down, and it's been very quiet. And that's one reason the Great Recession drug on for so long. And we had a very pro-cyclical policy, monetary policy stance. Everybody talks about quantitative easing. The quantitative easing didn't have much effect on anything. The broad money supply actually was not growing very much. And in fact, because money dominates, money calls the tune of everything. And the monetary policy overall was very tight after the Great Recession. So it was pro-cyclical. It wasn't anti-cyclical. It was doing exactly the opposite that any textbook would tell you should be doing. And it was mainly because of the regulations that were clamping down on banks.
What about the excess reserves and the interest rate that the Fed was paying on that to kind of keep a lot of that money?
Well, that was another thing. It's a tight money policy.
I never understood that.
They're paying for excess reserves that the commercial banks have on their balance sheets. A big chunk of their balance sheets are tied up at the Fed, getting interest from the Fed. And one way, obviously, to loosen monetary, if you wanted really to loosen monetary policy, the newspapers keep saying, and the central bankers say, well, at these low interest rates, we're all out of ammunition. We can't loosen monetary policy. We have to loosen fiscal policy. Well, fiscal policy is essentially irrelevant, and the monetary policy dominates. And how do you loosen it? It's very easy. You stop paying as much interest or pay no interest on excess reserves. The commercial banks would have a huge mountain of excess reserves, and they would decide whether it was prudent to extend credit based on those or not. And if they did, 90% of the money supply would start growing at a much more rapid rate than it's growing now, and you'd have a lot of looseness. The broad money supply would start increasing, and the Fed, for its portion of the broad money supply, would actually probably end up having to tighten.
Yeah, it never made sense to me. They're trying to engender inflation. They have all this money sitting on the sidelines that could help do it. I've always likened it to a giant water balloon of monetary liquidity hanging over the economy. But by the same token, they've got that policy to prevent the money from getting into the economy, but they were also trying and did ramp up financial assets, the values of financial assets, to create that wealth effect, and that's where the real inflation ended up.
Right. In other words, the low interest rates, the focus is just all on the wrong thing. The focus is on the interest rates, and this is from Keynes, liquidity preference theory. And the idea that everyone has, and you can't get it out of their head, is that there's a negative relationship between interest rates and the money supply, and interest rates drive the money supply. So if interest rates go down, interest rates go up, the money supply goes down. That's not the way it works in the real world. If it did, just look at Argentina. We talked about Argentina. Argentina has some of the highest interest rates in the world right now. And with the Keynesian liquidity preference theory and the idea everybody has about interest rates driving the money supply, the money supply should be shrinking and contracting in Argentina. It's not. It's growing. So there's a positive relationship between interest rates and the money supply, and the driver starts with the money supply. The money supply goes up, nominal GDP goes up, inflation goes up, and interest rates follow inflation. Interest rates follow inflation.
Interesting.
That's the relationship. Irving Fisher had all this worked out years ago, and no one even reads these classic books anymore and has it figured out. But you read the newspapers, everyone is obsessed about the federal funds rate and interest rates. You read the newspaper today, and that's all you'll be seeing. And the whining around, we've run out of ammunition because the interest rates are so low and we can't push them any lower. We're in a liquidity trap, and there's nothing we can do to increase the money supply. Well, that's just bunkum. There was a great letter in the Financial Times by Tim Congdon this morning indicating the foolishness of these statements that they've run out of ammunition, because all a central bank has to do is they can borrow money from commercial banks, okay, and use those borrowings to buy assets from the non-bank sector of the economy, the non-financial sector of the economy, and they can expand. You can always expand the money supply, a central bank, without limit.
I'm trying to think how to round this up. We covered a lot of ground there, Steve, and the main original point was just that you have been focusing on troubled currencies around the world, most notably in recent times Argentina and also Venezuela, and your advocacy is for dollarization, and if not full dollarization, to some sort of currency board. Brian's concern was that the US dollar was maybe vulnerable, which I guess you do not necessarily agree with.
No, but even if you have his position, which I've advocated. I mean, I have a book coming out in Turkey next month. I mean, it's in press right now in Turkish, advocating a gold-backed currency board. The anchor would be gold. If you like gold and you want to use it day to day as a currency, you have a gold-backed currency board. In some place like Turkey, the lira is a clone of gold. The currency locally is the lira, but it's redeemable into gold at a fixed exchange rate, and it's a clone of gold, and the deed is done. I mean, so there are ways to do this. One way is to have the anchor be the international currency, the U.S. dollar. And if you don't like the U.S. dollar for a variety of reasons, you like gold, whether you're Brian or whether you're me in Turkey, Iran, and Russia, and you don't want an anchor that's a fiat currency issued by a sovereign. You want gold that's not issued by a sovereign and is a very stable, holds its purchasing power and is very stable over long periods of time. You use gold. So
we're not in disagreement.
Basically, a gold-backed currency board completely accommodates Brian's love of gold and does so in a very practical way, because you don't have to worry about gold coins or anything like that. You got a paper lira in Turkey, and if you don't like it, you exchange it at the currency board at a fixed exchange rate for whatever that fixed exchange rate is for a physical amount of gold, so many grams of gold.
Yeah, and I think we agree more than we disagree, and I think we agree on the fact that the dollar is weakening against gold, and that's kind of the point. While it maintains strength against other fiat currencies.
Yeah, right. And right now, I think that the two factors behind that are the U.S. imposing financial sanctions on everything that moves under the sun almost, so people are worried about that. That's a huge uncertainty, so they want to get away from the dollar as a reserve currency. So Russia and China are doing this big time, and that's motivated the gold market. Also, you have a tremendous amount of just uncertainty, regime uncertainty out there, and the average guy, not a central bank in Moscow, but the average guy wants a little gold in their portfolio, and it doesn't cost them very much because interest rates are very low. So that's the gold market story.
Mm-hmm.
Yeah, well, Steve is very prolific in his content, so he has 146,000 followers on Twitter, which is enormous. So it's just Steve, that's EVE lower dash underscore Hanke, Hanke. That's probably the best place to follow him. He also has an email newsletter, which comes out sporadically, it seems to me. I guess every couple of weeks or so. His organization is the Institute for Applied Economics and the Troubled Currencies Project at the Cato Institute. So there's a lot of material there, and I've been citing his inflation numbers for many years now. So that's particularly handy. Steve, it's a privilege to have you on the show, and I'm going to continue plugging your material. People go to goldnewsletter.com/podcast for all the links at the show notes. Excellent, Steve. Thanks so much.
Thanks so much, Steve.
Yeah, thanks, Fergus and Brian. Good to be with you.
Cheers. Bye-bye.
Cheers. Bye.